Good day, everyone. I am Gretchen Vilayola, and I was assigned to report principles for managing credit risk. To be profitable, financial institutions must overcome the adverse selection and moral hazard problems that make loan defaults more likely. The attempts of financial institutions to solve these problems help explain a number of principles for managing credit risk. These principles are screening and monitoring, establishment of long-term customer relationships, loan commitments, collateral, and compensating balances requirements, and credit rationing. Asymmetric information is present in loan markets because lenders have less information about the investment opportunities and activities for borrowers than borrowers do. This situation leads to two information producing activities by banks and other financial institutions, namely screening and monitoring. When we say screening, it is an adverse selection in loan markets requires that lenders screen out the bad credit risk from the good ones so that loans are profitable to them. To accomplish effective screening, lenders must collect reliable information from prospective borrowers. Effective screening and information collection together form an important principles of credit risk management. Then, we have specialization in lending. One puzzling feature of lending is that a bank often specializes in lending to local firms or to firms in a particular industries such as energy. In one sense, this behavior seems surprising because it means that the bank is not diversifying its portfolio of loans and thus is exposing itself to more risk. But from another perspective, such specialization makes perfect sense. First selection problem requires that the bank screen out the bad credit risk. It's easier for the bank to collect information about local firms and determine their credit worthiness than to collect comparable information of firms that are far away. Similarly, by concentrating its lending on firms in specific industries, the bank becomes more knowledgeable about these industries and is therefore they're able to predict which firms will be able to make good payments on their debt. Another is monitoring and enforcement of restrictive covenants. Once a loan has been made, the borrower has an incentive to engage in risky activities that make it less likely for the loan to be paid off. To reduce this moral hazard, financial institutions must adhere to the principles for managing credit risk. That a lender should write provision or restrictive covenants into loan contracts that restrict borrowers from engaging in risky activities. By monitoring borrowers' activities to see whether they are complying with the restrictive covenants and by enforcing the covenant if they are not, lenders can make sure that borrowers are taking on risk at their expense. The need for banks and other financial institutions to engage in screening and monitoring explains why they spend money so much more on auditing and information activities. An additional way for banks and other financial institutions to obtain information about their borrowers is through long-term customer relationships. Another important principle of managing credit risk. Long-term relationships benefit the customers as well as the bank. A firm with a previous relationship will find it easier to obtain a loan at a low interest rate because the bank has an easier time in monitoring the borrower. A long-term customer relationship has another advantage for the bank. No bank can think of every contingency when it writes a restrictive covenants into a loan contract. There will always be risky borrowers' activities that are not ruled out. However, what if a borrower wants to preserve a long-term relationship with a bank because it will be easier to get an interest loan at low interest rate? The borrower then has an incentive to avoid risky activities that would upset the bank even if the restrictions with the risky activities are not specified in the loan contract. Indeed, if a bank doesn't like what a borrower is doing, even when the borrower is not violating any restrictive covenants, it has some power to discourage the borrower from such activity. The bank can threaten not to let the borrower to have new loans in the future. Long-term customer relationships therefore enable banks to deal with even unanticipated moral hazard contingencies. Banks also create long-term relationships and gather information by issuing loans commitments to commercial customers. So, what is loan commitment? It is a bank commitment for a specified feature of period of time to provide a firm a loans up to a given amount at an interest rate that is tied to some more interest rates. The majority of commercial and industrial loans are made under the loan commitment arrangements. Advantage for the banks is that the loan commitment promotes a long-term relationship, which in turn facilitates information collection. In addition, provisions in the loan commitment agreement requires that the firm continually supply the bank with information about the firm's income, assets, and liability position, business activities, and so on. A loan commitment arrangement is a powerful method for reducing the bank cost for screening and information collection. Collateral requirements for loans are important credit risk management tools. When we say collateral, it is a property promised to the lender as compensation if the borrower's defaults lessens the consequences of adverse selection because it reduces the lender's losses in the case of loan default. It also reduces moral hazard because the borrower has more to lose from a default. If a borrower defaults in lending, the lender can sell the collateral and use the proceeds to make up for its uses on the loan. One particular form of collateral required when a bank makes a commercial loan is called compensating balance. What is meant by compensating balance? It is a minimum deposit that must be maintained in a bank account by a borrower. Besides serving as collateral, compensating balances help increase the likelihood that a loan will be paid off. They do this by helping the bank monitor the borrower and consequently reduce moral hazard. Another way in which financial institutions deal with adverse selection is moral hazard is through credit rationing. It is the limiting the lenders the supply of additional credit to borrowers when it comes to fund even if the latter are willing to pay higher interest rates. credit rationing takes two forms. The first occurs when a lender refuses to make a loan from any amount to a borrower, even if the borrower is willing to pay in higher interest rate. The second occurs when a lender is willing to make a loan but restricts the size of the loan to less than the borrower would like. At first, we might be puzzled by the first type of credit rationing. After all, even if the potential borrower is in credit risk, why doesn't the lender just extend the loan but at higher interest rate? The answer is that adverse selection prevents this solution. Individuals and firms with the riskiest investment projects are exactly those that are willing to pay at the highest interest rates. If a borrower took on a high-risk investment and succeeded, the borrower would become extremely rich. But a lender wouldn't want to make such a loan precisely because the credit risk is high. The likely outcome is that the borrower will not succeed and the lender will not be paid back. Charging a higher interest rate just makes adverse selection first for the lender. That is, it increases the likelihood that the lender is lending to a bad credit risk. The lender would therefore rather not make any loans at a higher interest rates. Instead, it would engage to the first type of credit rationing and would turn down loans. Financial institutions engage in the second type of credit rationing to guard against moral hazard. They grant loans to borrowers but not loans as large as the borrowers run. Such credit rationing is necessary because the larger the loan, the greater the benefits from moral hazard. The larger your loan, the greater your incentives to engage in activities that make it less likely that you will repay the loan. Because more borrowers repay their loans if the loans amount are small, financial institutions ration credit risk by providing borrowers with smaller loans than they seek. That ends my report. Thank you for listening. Stay safe and God bless.